I was walking through the market the other day and I saw a sari shop,
Yeah.
and it struck me.
Hmm.
This is arguably the oldest fashion item in the world that is still in daily use. I mean, we are talking about a garment that is thousands of years old.
6 to 9 yards of unstitched fabric.
Exactly. It's the definition of tradition. It feels slow. It
Ooh.
feels like the opposite of the high-speed corporate world we usually talk about.
It really does. It creates a very specific image in your mind, doesn't it? The weaver in the village, the small mom and pop shop.
Right, the haggling. It feels like this uh, unorganized cottage industry.
And yet.
And yet you look at the stock market
Mm.
and you realize that there are companies trying to take that ancient, chaotic tradition and force it into a spreadsheet.
They're turning art into quarterly earnings.
It's a massive clash of cultures.
It is. And that is exactly what we're unpacking today. We're looking at the industrialization of the sari.
Specifically, a deep dive into Sai Silks, Kalamandir Ltd, or SSKL.
And the timing is perfect.
It really is. Today is Monday, January 19, 2026. The company just dropped a massive data dump on us.
Their financial results for the quarter ending December 31st, 2025. We have the investor presentation, the auditor's report, the whole 9 yards.
Pun intended.
I see what you did there. And looking at these documents, the mission for this deep dive is pretty clear.
How has a Hyderabad-based retailer scaled to nearly 80 massive stores across South India?
Right. We need to understand the mechanics of their business. But I think more importantly, we need to look at the cracks in the armor.
Because the data released today isn't all sunshine and rainbows.
No, it's not. There are some red flags in the Q3 numbers that we really need to dig into.
Okay, but before we get to the scary numbers, let's just figure out what this company actually is. Because when I hear Sai Silks, I assume it's just one type of store.
Mm-hmm.
But looking at their brand portfolio, it seems like they have, 5 different brands. It's almost like an identity crisis.
See, I wouldn't call it an identity crisis. I'd call it aggressive segmentation. They've realized that the sari buyer isn't one person. The woman buying a sari for a casual Friday at the office is in a completely different psychological state than the woman buying her bridal trousseau.
So they build different mousetraps for every type of customer.
Exactly. Instead of trying to sell everything under one roof, they have these very specific formats.
Okay, so let's walk through the traps. Who are they catching?
Well, at the very, very top of the pyramid, you have Mandir.
This is the ultra-premium one.
Ultra premium. High margins, designer labels. And the price points here are fascinating. They go all the way up to roughly 350,000 rupees for a single sari.
3.5 lakhs. Wait, that's not a piece of clothing. That is an asset class. You could buy a small car for that.
You could, and that's the point. It's an investment purchase. Then, slightly different but still premium, you have Kanchipuram Varamahalakshmi Silks.
That's a mouthful.
It is, but the strategy is razor sharp. It focuses almost exclusively on heavy silk for weddings.
But why separate that from Mandir if they're both premium?
Because the wedding market in South India it's a beast of its own. It is culturally mandated consumption.
Meaning you can't cheap out on it.
Exactly. You can cut back on Netflix, you can cut back on dining out, but you cannot show up to your daughter's wedding in a cheap sari.
Yeah.
So by branding this separately, they position themselves as the wedding specialist. It's their recession shield.
Okay, so that's the 1%. What about, the rest of us?
That's where the original brand, Kalamandir, sits. That's your middle-income, reliable, ethnic fashion.
Right.
But the real volume engine, the one that drives the footfall, is KLM Fashion Mall.
Value fashion.
Yeah.
I saw this. The price points here start at, what, 200 rupees?
200 rupees, everyday elegance. This is for the budget-conscious shopper who wants variety. And the beauty of this range is that they don't cannibalize themselves.
Yeah. You say that, but I'm a little skeptical. I mean, if I'm a customer and I see a KLM selling a sari for 500 rupees, and then 2 blocks away, a Maniri is selling one for 50,000, doesn't the cheap one dilute the brand value of the expensive one?
It would if they were in the same store. But by separating the physical storefronts, they protect that brand equity.
So you don't walk into a Rolls-Royce dealership and see a budget hatchback.
Exactly. They keep the environments distinct. However, your skepticism is very valid when it comes to their newest move.
You're talking about the 2025 launch, Sai Silks.
Yes. This is their 5th format, and it is a significant pivot. Sai Silks is focused on low-priced ethnic wear, but specifically, they are leaning into power loom categories.
Power loom. That sounds industrial. Usually these heritage brands are all about handloom and artisanal.
Right.
Moving to powerloom sounds like they're giving up on the art to chase the mass market.
It's a volume play. Pure and simple. Handloom is slow, it's expensive. Powerloom is fast and cheap.
So with Valley Silks, they're admitting there's a huge chunk of the market they were just missing.
A massive chunk. The people who want the look of silk but can't afford the hand-woven price tag.
So they're going downstream. They want to be the Walmart of Ceres as well as the Gucci.
Precisely. And that brings us right to the financial performance. Because executing a strategy this broad is expensive.
It has to be. Okay, so we have the data for the 9 months ending December 31st, 2025. What's your take on the big picture?
Well, if you just look at that 9-month aggregate, it looks like a growth monster.
It really does. Revenue from operations hit 1,234 crores. That's up over 16% compared to the same period last year.
Which, for a brick-and-mortar retailer in 2026, I mean, double-digit growth is hard to find.
It is, but dig deeper into the profitability. That's where the real story is.
Right. Profit after tax the PT, it surged. It went from about 72 crores last year to over 108 crores this year.
That is a 50% jump in profit on a 16% jump in revenue.
And let's just pause on that for a second because that is a really crucial concept. How do you grow profits 50% when sales only grew 16%?
It's operating leverage.
It's pure operating leverage. It means their fixed costs. The rent for the stores, corporate salaries, electricity, they aren't growing as fast as their sales.
So once those are covered, every extra rupee of sales flows almost directly to the bottom line. It shows they're getting more efficient as they scale.
Their EBITDA margins reflect that too, up over 30% to nearly 200 crores. So the machine is humming.
The machine was humming. Until we look at the specific quarter that just ended, Q3, October, November, December 2025.
Yeah, this is where the record scratches.
I looked at the Q3 column and I thought it was a typo. Revenue didn't go up, it dropped. It fell more than 8% compared to Q3 of last year.
And profits took a hit too, down from roughly 46 crores to 38 crores.
Hold on. How does a company that calls itself a long-term earnings compounder, their words, not mine, drop the ball in the most critical quarter of the year?
It's festival season, wedding season. This should be their Super Bowl.
It should be. An 8% drop in the golden quarter is not a stumble, it's a slide.
It's a valid concern. Now, we do have to consider the context. The Indian wedding calendar is lunar-based.
Right.
So some years, the auspicious dates are packed into Q3. Other years, they shift more into Q4. A shift in dates can really devastate these quarterly comparisons.
So you're saying it might just be a timing mismatch.
That is the charitable interpretation.
But the less charitable one.
The other interpretation is market fatigue.
Yeah.
Or maybe increased competition. Remember, the sari market is massive, and while SSKL is big, they are not a monopoly.
So if the consumer is feeling pinched by inflation, they might be trading down.
Skipping the Mondir purchase and going to a local competitor.
Or maybe going to Valley Silks. Is it possible they're cannibalizing themselves after all?
It is a possibility. When you introduce a value brand, you always risk trading down your own customers.
So if I buy a cheaper sari at Ltd, I'm not buying the expensive one at Mondir.
Right. But management is holding firm. They emphasize the 9-month view. They are basically saying, don't judge us on 3 months of bad weather, judge us on the year's trajectory.
And the year's trajectory is still very positive.
Very.
Fair enough. Let's talk about the logistics of all this.
Yeah.
Because operating 79 stores sounds like a nightmare. And looking at the map, they are incredibly concentrated.
They are. It's a very dense footprint.
Almost too dense. I mean, 31% of their revenue comes from Telangana alone, another 27% from Andhra Pradesh.
So nearly 60% of their business in just 2 states.
Yeah. And zero presence in North India. No Delhi, no Mumbai. Is this a lack of ambition?
No, I'd argue it's a very distinct strategy. They call it the cluster-based model.
Cluster-based. Sounds like corporate jargon for we open stores near each other.
It is, but the implication of that is huge. Think about the inventory. A sari isn't a carton of milk. It doesn't expire, but it does go stale from a fashion perspective.
Right. Nobody wants last season's design.
Exactly. Now imagine you have a standalone store in Mumbai, and a premium silk sari sits there for 3 months unsold. It's dead stock. It's trapping your cash. You have to mark it down heavily to get rid of it.
Which kills your profit.
Kills it. Now, look at SSKL's model. They have a cluster of stores in Hyderabad, a Mandir, a Kalamandir, a KLM, and now a Valley Silks, all within a short drive of each other. That same sari sits in Mandir for 2 months. No problem. They put it on a truck and move it to Kalamandir. Still doesn't sell. It goes to KLM as a high-value discount item.
Ah, I see. So the inventory just cascades down the value chain.
It's a waterfall system. And you can only do that if your logistics costs are low, which means the stores have to be close together.
If they open one store in Delhi, they couldn't rotate the stock. That sari would just die on the shelf.
Exactly.
That is actually brilliant. It turns the geography into a competitive advantage. It explains why they're sticking to the South.
They're prioritizing efficiency over just planting flags on a map, and this efficiency is vital because of how capital-intensive this business is. We need to talk about working capital.
I saw that in the IPO report. They went public back in 2023, raised a ton of money. And a huge chunk of it, over 235 crores, was for working capital requirements.
Which sounds boring, but for a retailer, that's life or death.
Right, it's the oxygen of the business.
Working capital, in this context, basically means cash tied up in saris. Unlike a grocery store where inventory turns over every few days, a silk retailer has to stockpile massive amounts of inventory months in advance.
They have to pay the weavers, stock the warehouses.
And just hold that inventory before the wedding season even starts. They are sitting on mountains of silk.
Mountains of it.
And that brings us to the supply chain. Because, and I can't stress this enough, you cannot automate the creation of a Kanjivaram sari. You can't 3D print it.
It's hand-woven. It's art.
It is. So how does a corporation that does 1,200 crores in sales manage thousands of individual artists?
That was my question. They claim to have a network of 4,000 master weavers and vendors. That sounds like a logistical nightmare.
It requires a massive human touch. They have an in-house procurement team of 80 people.
80 people just to buy the clothes.
Their sole job is to bridge the gap between the corporate boardroom and the loom. They have to travel to the villages, maintain relationships with the master weavers, check the quality.
You can't do that over Zoom.
You can't. But, and this is the key, they've overlaid a digital brain on top of this manual nervous system. They talk a lot about data analytics and ERP systems.
So how does that fit with the village weaver?
They track every single SKU, every sari individually.
So they know exactly which red sari with which border sold in which store at what time.
Down to the minute. They use data analytics to spot fast-moving design trends. Let's say their data shows that pastel pink with silver sari borders is flying off the shelves in Bangalore.
The system flags it.
The procurement team gets an alert. They immediately contact the weaver network to shift production toward those designs.
So they're shortening the feedback loop. Instead of waiting a year to see what's sold, they know in real time.
It brings the speed of fast fashion like a Zara or an H&M to the slow world of handloom. That is a massive competitive moat. The local anti-shop can't do that.
And that leads right into the macro picture. The investor deck quotes a report about the shift from unorganized to organized retail.
Which is basically corporate speak for the small shops are dying and we are eating their lunch.
It's a harsh reality, but yes, for decades, the sari market was dominated by these unorganized players. But the modern consumer is changing.
How so?
She wants a better experience. She doesn't want to sit in a cramped shop without air conditioning, digging through piles. She wants a trial room, a return policy, a loyalty program.
She wants the mall experience.
Exactly. And SSKL is positioning itself to be the destination for that migration.
And the sheer number of customers is growing too. The demographics are just undeniable. The female population over 25 is projected to reach, 45.5 crores by 2031.
That is a massive, growing ocean of customers. And let's be honest about the product itself. We talked about trends, but the sari is unique. It doesn't really go out of style.
No, it doesn't. A Kanjivaram sari is timeless. It is what I call culturally mandated consumption.
Culturally mandated. I like that.
It means that no matter what the economy is doing, if you are attending a wedding, you are buying a sari. It provides a safety floor for their revenue that a Western fashion brand just doesn't have.
You don't need a new pair of jeans. You need a wedding sari.
Exactly.
Okay, so let's try to pull all these threads together. We have a company that has mastered the cluster strategy for efficiency. They've segmented the market from 200 rupees to 3 lakhs so they don't miss any customers. They are tech-enabled, they are profitable, and they are growing fast on an annual basis.
That is the bull case.
We have the bear case, that Q3 drop, an 8% revenue decline in the most important quarter.
And the risk of dilution with Sai Silks.
It's a classic tension. The 9-month trend says growth monster. The Q3 trend says caution.
It does.
If you were sitting in the boardroom today, looking at that Q3 red ink, what is the one thing you'd be losing sleep over?
I not be worried about the margins moving forward. Think about it. They are aggressively expanding Valley Silks. They are selling power loom saris for cheap.
Right. It takes a lot of 500 rupee sales to match the profit of one 50,000 rupee sale.
Exactly. As they shift their sales mix toward the mass market, their revenue might go up, but their profit margins could get squeezed. They are trading high value for high volume.
And that's a dangerous game. If you don't manage your costs perfectly, you can sell millions of saris and make zero money.
That is the danger of the Walmart strategy. You have to be perfect on efficiency because your margins are razor thin.
So they need to ensure that Valley Silks adds to the bottom line without dragging down the brand equity of their premium stores.
Yeah.
It's a delicate balancing act.
It is. The big question is, can they be everything to everyone? Can they sell the cheapest power loom and the most expensive hand loom without breaking the machine?
SSKL seems to be betting the farm that they can.
As long as they keep the brands in different buildings and keep that inventory moving?
It's a fascinating experiment in retail engineering for anyone listening who wants to actually see what we're talking about. The visuals of these stores are stunning. They really do look like palaces.
They do.
We've linked the full investor presentation in the show notes. Go look at the photos. It helps you understand the scale we're talking about.
It really does. The visuals drive home the difference between a shop and what SSKL is building.
Well, there you have it. Sai Silks, Kalamandir Ltd, an ancient garment, a modern algorithm, a great 9 months.
And a scary 3 months. It's going to be a very interesting year to watch.
Absolutely. Thanks for unpacking this with me.
My pleasure.
And to our listener, keep watching that ticker. And maybe next time you see a sari, think about the ERP system behind it. We'll see you in the next deep dive.